Today, I just want to start with something simple that happened to me this past week. I was talking to a friend who works at a mid-sized tech company and I asked him how the AI transformation was going at his job. You know, every company in America has been announcing some kind of AI initiative over the past 3 years. AI is going to change everything. AI is going to double our productivity. AI is going to revolutionize how we work. And this guy looked at me, shrugged, and said, honestly, nothing really changed. We got a chatbot that half the team uses sometimes and one executive who adds AI to every slide deck whether it belongs there or not. And I thought about the conversation when I saw the report that came out from MIT. MIT studied real companies running real AI deployments with real money. And what they found is that 95% of organizations are getting zero measurable return on their generative AI investment. Not 10%. Not 20%. 95%. Zero return. And a separate study from the National Bureau of Economic Research published in February 2026 found that 90% of firms reported no impact of AI on their workplace productivity at all. So here we are. Companies collectively spending $700 billion this year alone on AI infrastructure. And 9 out of 10 businesses using it cannot point to a single measurable improvement in their productivity. That gap between the spending and the actual return is not a small thing. That is the exact definition of a bubble. And right in the middle of all of this, while the stock market is popping today on the Iran ceasefire news, while oil is crashing and the S&P is surging, there is a story developing quietly underneath all of that relief that most people are not paying attention to. And it involves the companies that just spent an absolutely historic amount of money on a bet that is not paying off the way they said it would. Today we are going to walk through what is actually happening in this AI spending race, why one company that everyone called a failure for the last 3 years might actually be the winner of all of this, and what it means for your money in a world where the Cleveland Fed just reported the highest monthly inflation since 2022 and used car prices are jumping again like it is 2020. Let us get into it. Let me put some real numbers on this because I want you to actually feel how big these are. Google, which is technically called Alphabet, is spending between $175 and $185 billion on AI infrastructure in 2026. Not over several years. This calendar year alone. Amazon is spending $200 billion. Meta, which is Facebook's parent company, is spending between $115 and $135 billion. Microsoft is spending roughly $145 billion. And Oracle is spending over $40 billion on top of that. Add those up and you get somewhere between $650 and $700 billion in AI spending from just 5 companies in a single year. For context, the entire GDP of Switzerland is about $900 billion. We are talking about 5 tech companies spending in 12 months almost enough to buy an entire developed country's economic output. And here is the question that should be on everyone's mind right now. Where is the revenue? Because U.S. consumer revenue from AI services right now is roughly $12 billion annually. AI spending, $700 billion. Revenue from AI, $12 billion. You do not need to be a financial analyst to see that those numbers do not line up. That is like spending $700,000 to open a restaurant and bringing in $12,000 a year in sales. You cannot run that math for very long before something very bad happens. And it is already starting to happen. Look at what has happened to the software companies that were supposed to benefit most from the AI wave. Adobe is down 65% from its highs. Salesforce is down 51%. Atlassian is down 85%. These are not small startups. These are major companies with billions in revenue getting absolutely crushed because investors are waking up to the fact that the AI revenue story is not arriving on the timeline everyone assumed. Meanwhile, one company was sitting quietly with $130 billion in cash and liquid assets and not joining the race at all. And every financial headline spent 3 years calling the company a failure for it. We are going to talk about exactly who that is and why it changes everything. Stay with me. While Google was announcing $185 billion in spending and Amazon was announcing $200 billion and every financial headline was about the AI arms race, one company was sitting with $130 billion in cash and not joining the race. Apple. The company everyone has been calling a failure in AI for 3 years straight. I cannot tell you how many headlines I read about Apple falling behind. Apple is losing the AI race. Apple's Siri is a disaster. Tim Cook has no AI strategy. Analysts issued downgrade after downgrade. Every tech podcast was talking about how Apple was going to be left behind as the most important technology shift of the century passed it by. Here is what Apple was actually doing during all of that. Apple spent $12.72 billion on capital expenditure in fiscal 2025. That is a 35% increase from the year before, which means they are not standing still completely. But it is still less than 1/10 of what Amazon alone is spending. Apple chose deliberately not to join the arms race. And over the last 4 quarters, Apple reported over $400 billion in annual revenue and nearly $100 billion in free cash flow. Now think about what that actually means. Every dollar that Google spent on AI infrastructure this year is locked up, sitting in a data center somewhere burning electricity, depreciating every single day, requiring ongoing maintenance costs and energy costs that are going through the roof because of the Iran war disruption. That money cannot be redeployed quickly if the strategy needs to change. Apple's $130 billion can go toward literally anything right now. An acquisition, a partnership, a new product launch, a buyback, or just sitting there earning interest while the dust settles and the real winners and losers of the AI era become clear. This is what financial flexibility actually looks like. And you cannot recreate it once you have committed to $185 billion in annual spending. Once those contracts are signed, once those data centers are under construction, the flexibility is permanently gone. Apple still has all of it. I want to come back to that 95% number because it is the most important data point in this whole story, and most people are glazing right past it. MIT's Nanda Research Group published their findings in August 2025. They looked at $30 to $40 billion in enterprise investment into generative AI across real businesses. Actual money spent on actual AI tools in actual companies. And 95% of those organizations reported zero measurable return. Zero. And then the National Bureau of Economic Research confirmed it in February 2026. 90% of firms reported no impact on workplace productivity at all. These are the companies that are buying the tools from Google and Microsoft and Amazon. These are the customers who are supposed to generate the revenue that justifies all that infrastructure spending. And they are reporting that the tools are not working at the scale that was promised. Now here is something almost nobody is connecting right now. The Iran war. The same conflict that drove gas prices up 32% in a single month. That war just halted Qatar's helium production. Qatar supplies about 1/3 of the global helium used to manufacture computer chips. No helium means chip supply problems. And these are the same chips supposed to be powering all those AI data centers that big tech just committed $700 billion to build. And energy prices are skyrocketing because of the war, which drives up the operating costs of every single one of those data centers. So the companies that overcommitted to AI infrastructure are now facing rising costs to run it at exactly the same time the revenue from that infrastructure is not showing up on schedule. Apple has almost none of that exposure. Apple did not build the data centers. Apple does not have the energy contracts. Apple kept its $130 billion. And right now that decision is looking like one of the best calls any company in America has made in the past 3 years. Now let me address the obvious objection, because I know a lot of you are thinking it right now. Apple is just late to AI and they're going to get left behind. Everybody is going to be using Google's AI or Microsoft's AI, and Apple will be stuck with nice hardware and no real AI story. Let me show you exactly where I have heard that argument before. When portable music players first hit the market in 1998, 3 years before the iPod, people said Apple was late to digital music. The Diamond Rio was already on shelves. And then the iPod and iTunes came out in 2001, and Apple dominated digital music for 2 decades and generated more money from it than almost any other consumer tech product in history. When Samsung and Sony had smartwatches on the market years before 2015, people said Apple was late to wearables. Where is Apple's smartwatch? They are falling behind. And then Apple Watch launched in 2015 and became the best-selling watch in the world within its first full year on the market. When a company called Bragi shipped true wireless earbuds in 2014, 2 full years before AirPods, people said Apple was late to wireless audio. And AirPods became one of the highest-margin consumer electronics products ever made and basically created the premium wireless earbud category as we know it today. and the iPhone in 2007. BlackBerry owned corporate email. Nokia was the global mobile leader by an enormous margin. Apple was late by every single industry standard. And then Apple redefined every standard that industry had. The pattern is identical every single time. Apple watches. Apple waits. Apple lets other companies spend billions figuring out what customers actually want. And then Apple enters with something that captures most of the profit in the category even when it does not capture the most units. Apple does not pioneer. Apple perfects. And right now with AI, Apple is in the watching and waiting phase of that exact same playbook. The only question is timing, and that timing is getting closer every single day. Here is the piece of this story that makes the $700 billion spending race look even more questionable the longer you think about it. The AI model market is collapsing in price, and it is happening fast. Anthropic, which is one of the leading AI companies in the world, cut its prices by 67% recently. Google slashed its AI API rates between 70% and 80% on successive model updates. OpenAI has repeatedly reduced costs on each new version it releases. When prices in a technology category drop 70% in a short period, that is not the sign of a thriving premium market. That is the textbook definition of commoditization. And when something becomes a commodity, the companies that spent the most money to be first in that race often end up worst positioned because the advantage from being first disappears when the underlying product becomes interchangeable and cheap. Think about the broadband build-out in the early 2000s. Telecom companies spent hundreds of billions of dollars building fiber infrastructure. And then prices collapsed and a lot of those companies went bankrupt or got absorbed for pennies on the dollar. The technology was real. The infrastructure worked. The problem was the economics of who was building it and why. I am not saying the exact same thing happens to Google and Meta. These are far stronger companies than the telecoms of 2001. But the principle holds. If AI models become commodities and 70% price drops, say they already are, then the advantage from spending $185 billion to be first in that commodity race looks very different than it did when those commitments were made. And here is what Apple can do right now that nobody else can. Apple can access those commoditized AI models at cheap or near free prices because the providers are desperate for distribution at scale. And Apple can layer those models onto 2.5 billion active devices. 2.5 billion people who are already paying for Apple services and who have proven decade after decade they will pay premium prices for a seamless integrated experience. You do not need to build the best AI model to win the AI era. You need to put the best AI experience in the hands of the most people. Apple has the people already. It just needs the experience. And it can now buy that experience at a discount. Here is why this story matters even more on April 8, 2026 specifically than it did 3 months ago. Because everything happening in the broader economy right now is making the AI bubble risk worse at exactly the wrong moment. The Cleveland Fed reported today the highest monthly inflation reading since 2022. That is not a small data point. And Wolf Street reported that used vehicle wholesale prices jumped 4.2% in March alone and are now up 5.7% year over year. That is the exact same pattern that kicked off the broad inflation wave we lived through in 2020 and 2021. Anyone who was paying attention back then knows how that movie ends. Gas prices have already jumped 32% in about a month because of the Iran war. Restaurant sales fell every single week in March. People whose budgets are getting squeezed from every direction right now are not going to be the customers signing up for a $20 a month AI subscription from Google or Microsoft anytime soon. The AI revenue story depends entirely on consumers having enough money left over to pay for AI services. But the consumers who were supposed to be the revenue base for all this AI infrastructure are getting hammered right now from every direction. Gas up 32%. Food costs up. Insurance up. Used cars jumping again like 2020. The money that was supposed to flow from households into AI subscriptions has to come from somewhere. And right now that somewhere is running dry fast. Goldman Sachs estimated total AI capex will hit $539 billion in 2026. Actual consumer AI revenue right now is $12 billion. That gap does not close when your customers are choosing between filling up the gas tank and buying groceries. This is not just a tech story. It is an economic story. The AI bubble and the broader cost of living crisis are colliding at the exact same moment. And the companies most exposed to that collision are the ones that committed $185 billion or $200 billion to infrastructure that depends on a consumer base already under serious financial pressure. Let me give you one more data point that really crystallizes how unstable this whole situation actually is right now. OpenAI, the company that started all of this. ChatGPT, the one that triggered the panic that sent every tech company racing. Here is OpenAI's current financial reality. They have committed to spending $1.4 trillion over 8 years on data centers and infrastructure. They have roughly $20 billion in annual revenue now, which sounds like a lot until you look at the spending. And analysts who have examined their burn rate are projecting that OpenAI could run out of money by mid-2027 without additional fundraising. The company that started the $700 billion arms race might not be able to sustain itself through the race it started. And yet the spending commitments from Google and Amazon and Microsoft that were triggered by OpenAI are already locked in. You cannot unbuild a data center. You cannot unsign a multi-year GPU contract. The spending is committed and it does not come back if the revenue does not show up on schedule. So what do you do with all of this? First, if your retirement account is heavy in large-cap tech, understand that you are carrying significant AI bubble exposure whether you realize it or not. 80% of S&P 500 gains in 2025 were driven by AI-related stocks. If you own an index fund, you own a lot of that exposure. Second, pay very close attention to the Q2 and Q3 2026 earnings reports from Meta, Google, and Amazon. Analysts are calling this the highest risk window for the AI spending story. If those reports cannot show infrastructure spending is starting to generate proportional revenue, Wall Street's patience will snap. Third, watch Apple. Not as investment advice, but as a signal. When Apple makes its AI move, it comes with 2.5 billion devices in hand, a balance sheet untouched by years of infrastructure spending, and a customer base proven to pay premium prices. And fourth, right now, with inflation ticking back up and budgets getting squeezed, build that emergency fund. At least 6 months. Preferably a year. Because the cost of living crisis and the AI bubble are on a collision course, and prepared people are going to be in a very different position when it hits. Here is where I leave you. Apple has $400 billion in annual revenue, $100 billion in free cash flow, $130 billion in liquid assets, and 2.5 billion devices in the hands of people who have proven they will pay for quality. While big tech committed $700 billion to infrastructure that 95% of users cannot show any return from, Apple chose patience and kept every dollar of flexibility. Adobe down 65%. Salesforce down 51%. Atlassian down 85%. Meta down a third of its value. OpenAI possibly running out of money by 2027. And Apple sitting there with $130 billion in cash and the same playbook it has run successfully 4 times in 4 different technology categories. The AI bubble is cracking. The company that everyone said was losing the race might be the one that ends up winning it. Make sure you are subscribed because this story is moving fast and the next chapter is going to matter for your financial future. Check out the next video on the screen right now. I will see you in the next one.